we are going to discuss about concept related to the return calculation and risk measurement. In the last lectures, we have discussed about types of financial securities. You may recall that when I started discussing about the distinction between financial securities and real securities, I explained that any asset has certain payoff. So when we are discussing in terms of financial securities, then we are interested in what return payoff is provided by these securities. So there are various concepts which are related to returns. Like we will start with the simple calculation of return, how return of a particular security is calculated. Then we will discuss about some adjustment in the return, like tax adjustments, role of an impact of inflation on return, and also we will look at when the investment is made across borders, that is portfolio investment, what other factors kick in, what other factors are important. So let us try to understand you know that I have already explained to you that why returns are important, and there are two concepts which I should make clear before I start discussing about the calculations. The first concept is what we call it the historical return. The return which is just 1 minute. The one is the historical return, that is based on the past return, past price history. We calculate the return of a particular asset. This is called the ex-post return, which happens. Then there is expected return, because you know that whenever one is making investment, then one is making investment for the future. So this is called expected or ex ante return. Now, naturally, the expected return are based on historical return. So therefore, our focus will be based on first on historical return calculation, then certain thing about the expected return also, because we assign probabilities, to arrive at the expected return. So let's get going and try to understand the return concept, and we should keep in mind that why returns are important, because they have got immense use, use in variety of settings. Like if you want to find out a security for investment, we can use the return to determine whether the security is underpriced or overpriced, whether to buy it or not. And another important thing is that when you are calculating the cost of capital in the financial management course, you may have come across in capital budgeting. Cash flows are there. Cash flows outflow is there, and then certain projects are there which provide inflows over a certain period of time. And then we try to discount these cash flows by certain discounting factor. Now, this question that what discounting factor cost of a capital should be used can also be obtained through rate of return. And another important thing is that the future performance has also roots. The future performance evaluation has also roots in cost of capital. So it's got variety of applications. Not only a selection of securities, but performance evaluation and cost. There, the answer was not provided. The cost of capital that or they're 10%, 15%, without providing the background, without providing the underlying factors, what determines why should we use 15%, why we should not use 12% or 8%. So that answer was not provided. So that has a basis, like as we will see in the third unit, there is a model which is known as CAPM, Capital Asset Pricing Model, which is based on the discussion which we'll have, that provides benchmark that can be used for calculation of the cost of the return or the cost, because rate of return and the required return are the equivalent in some way, but there is some difference which I will be explained at right point of time. Now let us try to understand calculation of return. For instance, if somebody has purchased any stock, let us say equity stock, and keep in mind that equity stocks are those stocks which provides ownership, that they are the stocks which are held by the shareholders. So the return of these stocks can come either in the form of dividend, which is paid out of the profit, or it may come in the form of capital appreciation, that is capital gain or loss. So let us assume that a stock is purchased at period T at 110 rupees. Now this stock after, let us say, 1 year, the prevailing price of this stock is 120 rupees. Okay. Now, and also assume that during this period, let us say 2 rupee dividend is paid per stock. So in order to find out how much return has been provided by this security, what we will do that we will subtract the ending value, end market value, that is the prevailing, minus the beginning market value, which is this. This is B, this is EMB, this is, this is BMB, this is ending market value, EMB, divided by this 110, and this will provide us how much capital gain we have received it. Now, another element is there, which is described here as capital gain or loss, because the prices have gone up here from 110 to 20, therefore there is a gain. If the price was, let us say, 105, then there would have been a loss, 105 minus, so the appreciation. Also assume that this stock has provided certain income in the form, naturally the income will come in the form of the dividend, 2 rupee dividend. So naturally the beginning market price will also be added here. 2 divided by 110 will provide that what is the return which has been generated because of the distribution of dividend. So in this way, we can calculate the return of any stock. For example, we can find out the price at certain. Now the period will have to be decided whether you want to have a daily return, weekly return, monthly return, yearly return, or whatever like that. So at 2 period of time, so in this way we can arrive at. Now, and here to keep in mind one more thing, that many stocks do not provide this part, dividend. So only the return will come through this. So I think that if you put these values, you can find out 100, this is 110. 110 divided by this 110 and plus this part, that is, so either you can use this thing because denominator is same. So So you can like 10 plus 2 divided by 110. So you can find out 12 divided by 110. So the return. So many stocks do not provide dividend, and so therefore the return will come. So in this way, we can calculate the return of equity stock. You know that the return of a fixed security is known. You know that it provides rate of interest in advance, 10%, 15%. It is known that so this situation will not arise in terms of the fixed income because they have got a predetermined payoff. So, but the price of those securities may vary depending upon the variation in rate of interest prevailing in the market. So I will see in the fourth unit in bond valuation that during the life of a bond or fixed income, the price may undergo change depending upon the variation in the rate of interest. So this is how we calculate the rate of return of any stock. Now, this is not the complete story. What happens that when a return is calculated, then a part of is may also go, for example, a capital gain tax, or if some person receive dividend, so they may be subjected to tax. Now, for example, in India, there is a short-term and long-term capital gain, but for the moment, just forget about that. The point which I am trying to, bring home, underline, is that the return should be adjusted for the tax which the holder of that security will pay. So, for instance, if the return is has been received, but a person is, let us say, in 30% income tax bracket, so that income will be deducted by 1.3. It will be left with 70% of the income. 30% will go for taxes. So that is why one adjustment is made, 1 minus T, that is the amount of tax which is paid, and there are various options available, like in India, for example, Provident Fund is tax free, 8.5% tax free. So, but others may provide 12% rate of return. So a person who is receiving 12% return and he is income tax bracket of, let us say, 1 minus 0.3. So it means that 12 into 0.7. So its return will be, after tax return will be 8.4%. So it is lower than the PF after tax. So that is why tax is an important factor also of what is the after tax return, and that we should take into account. So an adjustment is made. Then one more thing is there, that the inflation also affects the rise in price. For instance, 12% return is coming, but the prices are rising more than that. So then it will be real return will be lower. So, and another important thing is that I will explain one by one this thing in some more detail. The currency transaction, like, if somebody is making investment from US to India, let us say. So naturally, dollar will be converted into rupee. And then after that period, the money will go back, the converted into dollar, and will. So that is the exchange rate comes in the picture. So let us try to understand it further, and what adjustment will be made in the formula is simply this, the original formula. Here what we will do, that we will make adjustment in the ending market value market. Let us assume that only dividend is taxed. Nidal Ahmed.
Yes, sir.
So what is the issue with that? You are trying to create some caricature of this return?
No, sir, I was trying to save the image and I accidentally touched the pen. I'm trying to erase it now.
Okay, no problem. So you see that here I am assuming here that the dividend is taxed, not the capital gain. But if the capital gain is also taxed, then there here also it will be, if somebody sells off, so it will be subjected to the same one minus, that is the tax bracket, and plus this. So the point here simply is this, that the simple return is not important, but after tax return is also important. Now the question may be that when a person disposes of his share, he will be, one will be subjected to capital gain, and like for example, the if not, then will not be subjected to whenever is sold off. But dividend is tax, dividend tax, and that is why in the past the dividend was not taxed. The level playing field for equity, it is beyond understanding why debt is given tax, you know, the tax benefit, and why equity is not provided that benefit. So that is a different sort of question, but I'm just trying to point out these things. So, but after tax return important, as I said, that provident fund return, which was 8.5, the example I gave, a stock which I said which provided 12% rate, and if the person happens to be in the highest income tax bracket, the return will be same. That is why in recent time government, because 1 crore people were parking 1 crore, more than 1 crore in the provident fund. So that is why the government has come out with the tax that if your investment in provident fund is more than this, then you will be subjected to that. Because you know that after the 12% and that we may become equivalent because of that. So this is adjustment which we make it, and this is the same thing which I have already explained to you, the capital gain part. Just now, the return after tax return, other tax returns are important. Real calculation we will take later on in Excel and other sheet. So that thing, but I think that is the simple arithmetic which I am explaining to you. The inflation. If a stock is providing 12% return, but prices are also rising by, let us say, 12%. So in real term, the real return is zero. Or if prices are more than this, then 14 minus 12, the real return is minus 2%. So that is why the rise in price has also got important. For example, in recent times in India, the deposit, the bank, the interest rate on bank deposits were 8%, 6%, or something like that. So the rise in inflation was much higher than that. In real term, those person who had made investment in bank deposits, we are getting a return which was not inflation adjusted. It was lower than the rise in price to compensate for them, like that. So this is also important, that when we are looking at real return, we may look at also. So there is a theory about the interest rate given by Irving Fisher. And in international finance course, you will come across that theory, which is known as interest rate parity theory. Interest rate parity theory is in the domain of international finance, but it has domestic counterpart. Is that what Fisher pointed out, that countries which have got high inflation, they will have high interest rate. Meaning, if inflation in certain countries is high, the rate of interest will also be high. If countries have got lower inflation, they have lower rate of interest. And he says that in some extreme cases, the relationship is 1:1. If prices rise by 10%, inflation, the interest rate will also rise by 10%. 1:1 means that it will be the mapping will be exactly But he pointed out in his theory that the real the nominal rate, that is the rate which is quoted in news, the financial press and everywhere, is nominal rate. It is not the rate which is adjusted for inflation. Like a bank quote that you keep money in bank, you will get 8%. They do not say that it is the real rate of interest is after adjusting 8%, like 7% is only 1% real rate of interest. They do not quote it. It is not quoted there. So he said that the nominal rate is the product of inflation and the real interest rate. And he says that real interest rate is a very important, very small percentage, maybe 1% or 2%. So here, if you see the case which I have, the example I have given, 8% rate of interest, inflation is 7%, the real return is 1%. So this is very low, and in some cases negative. As I told you that the bank deposits in India were hardly provided a hedge, a compensation for the rise in price, and that is why those who are aware of these things, they may not keep their money in a bank. Rather, they may opt for other investment avenues. So inflation is also a very important factor when you are looking at what has been the return in the real term, not the nominal return. But as I have told you, that the financial press and the people look at, because a type of illusion in economics, we call it, there is a money illusion. We do not lift the veil to understand what is the real interest. So a kind of, for example, if you come across 14% return, do not look in that through that what is the real. Government announces dearness allowance, people think that our income has gone up, but it is just a compensation, it is a kind of money illusion. So then this is not the complete story about the return. Then returns are also affected by, if you are nowadays, when people are making investment, as I told you, across border, global investment, when money is flowing from one place to another place, then why this movement takes place from one place to another place? The reason is very simple. For example, if USA and India, let us say, example of two countries, the reason is that the Indian market provides higher return than the US market. So the money, the financial flow may come to India, let us say, the portfolio investment. They make investment in stocks. FIs and others, foreign, they make investment. Now let us say the US stock market is providing a return of 3% on 3%, 4% in US is very high. Please keep in mind. That is why the Trump gained a lot of popularity, because the stock market return was very high in comparison to the past return in US. Let us say 3%. And India, the return provided by very conservative estimate, let us say stock on an average is providing 13% if you make investment. The portfolio may provide 13%. The difference is 13 minus 3, that is 10%. That is why this, because the return differential is there, that the money flows from US to India. So to take advantage of this high return. Now, this money will not stay here forever. Naturally, those who make investment, then after the certain period, they will send back the money, remit the money back to US. So first, they will convert dollar into rupee to make investment, and then they will convert the return generated in rupee back to dollar. So rupee to dollar. Now the case may be that in please remember that exchange rate fluctuates. during this period, and naturally exchange rate is not a still thing, it fluctuates. And assume that the rupee depreciates against dollar. Just 1 minute, there was an issue with the, I will see to that, what is the issue. So there are sometimes issues. I do not know why this happened, that suddenly it stopped working. So I was explaining that the return was, the difference was 10% return differential between USA and India. And then during this period, exchange rate, rupee dollar exchange rate change, and rupee depreciated by 10%. It means that depreciation of rupee. What does depreciation of rupee mean? That more amount of rupee will be needed for getting a dollar. So if we assume that if let us say just 70 rupee and it becomes, I'm not exactly the figure is there. Let us say it becomes 77, just an example. So it is called depreciation. Okay. Now it means that more amount of the rupee will be needed for getting $1 when the US investor converts into dollar. So this 10% gain in the return may be dissipated, may be nullified by the loss in the depreciation of 10%. That is why the in global the portfolio investment, international portfolio investment, not only the returns are important, but exchange rate gain or loss is also important. And that is why when I was referring to interest rate parity theory, that Fisher domestic Fisher effect theory, so there is also a theory related to that, which says that international parity theory. It says that the exchange rate moves to counter the interest differential. Whatever difference in rate of interest or other is there. For instance, US and India, if the return differential is 10%, then the rupee will depreciate by 10% to account for. Otherwise, it will create a money making, it will become a money machine, arbitrage, moving money from one place to take advantage of high interest rate and then remitting back the money. So it in the long run, what will happen that the exchange rate will move to compensate, and that is why. And one more thing is there, that those who make investment inside, they also hedge. They can also, yesterday I was referring to the futures, forwards and futures or options. So they can buy currency options to hedge that the exchange rate does not affect them. But the point here is very limited. That what I'm trying to explain to you is that this is the equation which you will encounter. That is exchange rate, dollar, domestic currency, foreign currency, period O and period N. This is the return. -1 simply means that the actual return which will arrive at. So simply this is the product of this as well as the return which we get. So exchange rate is the return becomes not only the return, the raw return, but the return, the gain or loss in exchange rate. So not only the exchange rate gain or loss, for example, depreciation by 10% is a loss, plus the return. If it is 10%, then it means that it will be zero. But if exchange rate is depreciation is 8% and it is 10%, then it means that only return will be 2%. So the exact formula is there, which you will study in the international finance, and in the last part, fifth unit also, we will refer to these things. But we will not go in that detail like a course like international finance. We will just provide you some basic understanding of these things. So that is why in global portfolio flow of it also becomes important. So these are some of the measures, like we started with the return calculation. So return calculation of equity stock is based on the capital gain plus the dividend. Then we looked at that the inflation, the tax may affect the return. Then we try to understand the effect of rise in price, that is inflation. Then we also try to look at in the global context, if you are making investment, and in the current scenario, the globalized world, the flow of money from one place to another is very common, because to take advantage of high return provided by a lot of money has flown to India, because the return in Indian stock market is very, very high, very, very high in comparison to other countries. Otherwise, when a global portfolio manager is there, the world is stage, any country in Latin America or the other side of the continent, African or any other. So India is not those. The entire list is there, the emerging and other kind of market where the money can move. Naturally, not only this return is the factor, but other factors are also there. Like international business, you may have studied like that when your money is flowing, like the political and other stability and other things may also be considered, but for the purely monetary term, these are the factors. So, but that one is making investment, then one period return is not important, that you calculate the return of certain period, 1 month or 1 year, and then try to look at. For that, you need the return calculation for a period of time. Not that maybe if you are making investment, maybe 5 years, 10 years, monthly return history is there. Then one would like to have an idea about how much return has been generated by a particular financial asset during that period. That leads us to the concept of summary statistic, which provides, the average return which the stock has provided or an asset has provided during this period. So the calculation is same. I'm leaving these things. So you can go through my slide. I'm coming to the one important measure is that we take the average return. Now, average has got its pitfalls, but for instance, let us say the return of a stock is 10% in one period, 2, 3, 4, 5, 6. Then let us say these are the yearly returns. You calculate it 12%, then 8%, 4%, and 7%. So we just sum up these and divide by 6, whatever. So we get the average return. So maybe, there is a variation, that is in some cases from 12% to 4%, it swings. So it gives an idea about the dispersion of return about. So one of the most widely used and prevalent method for calculating return is average return. But average return has its own shortfalls, which will I explain to you. So, but it provides a fair idea about what has been the return during the period of not only one return which one can calculate, but a series of return which you try to look at the average return. So this is one method which is normally used in arriving at whether decision about making investment. But arithmetic return has its issues. In some cases, arithmetic return, like the story of a person who tried to cross the river by taking into account the average depth of the river, and finally he drowned. So that is why there is always pitfalls. So in some cases, what may happen that if there is a wide variation, for example, if the return would have been, let us say 4% to 20%, this is wide variation, then average return will give a very deceptive picture of this thing. And in some cases, what may happen that actually there is during that holding period, that period of investment, there is no return yet actually, but average may provide some positive return. That is why there is a concept of another which we use it is called geometric mean return. So if the multiple period and a longer period is used, then this may provide, and this always be lower than the arithmetic mean. How we calculate it? Before that, let us try to understand intuitively these things. So I'm leading in my slide. I'm not reading from my slide, just trying to give you the overview of that. When you get the slide, you can read these things. So consider a stock whose price is 100. At the end of the year, let us say, the price declines to 80 at the end of year 1 and recovers to 100. It is simply saying that 100 rupees, then let us say TO, and this period 80, and then again recovers to 100. So naturally for this period, you will calculate 80 minus 100 divided by this, okay, first period. Then second period will be 100 minus 80 divided by 80. Okay. So this will give a return for this period. Now, if you calculate for this period and take the average, so for this period it will become out to minus 20%, and for this it will become out 20%. Now, if you take the average, it will tell you that it is 2.5%. Whereas you see that you started from 100, the price is 100. So because the dispersion is so much in the return that that the average is providing, yet the price is still 100 from where you started. So that is why if there is a variation, dispersion in return, then geometric return is preferred over the arithmetic return, and that can be provide a more reliable measures of the return. So as I have already explained you, multi-period context. So this is the formula for calculating of, when I take up the other aspect in Excel also. So what we do that in order to find out, we convert the return. For example, their return was, go back to this. So what we do that in using this formula, we calculate the returns for each period. Like there was minus 20, what we do that 1 minus this, so it will be 0.8, okay, the return. Then for other period 1 plus 0.25, so it will be 0.8 into 0.125 for 2 periods, and so on and so forth. So we take the product of this thing, and that gives the total return, and when we subtract from it, gives the return for that period. So this is is that from period I to period T, and then we take the nth root, or the number of periods which are there. If 5 periods are there, we will take the nth root of that, and that will provide us the geometric return for that. So this is how we arrive at the geometric return. As I told you, that geometric return is a better indicator of the return if multi-period context is there, and also disperse. Some people have come out with the formula where both, both arithmetic and geometric is plugged into to take into account this thing. Like Bloom has come out a formula which is, but the gist of this is like here it is given an example. Same thing I have explained to you. So the example is 1.91, so it will become 1 plus the return, that is 0.9. So we are converting decimal, 1.4, 1.2, because return is negative, so it will become 8. And then we are taking the fifth root of this thing, it will be 1.089, that is the 1 rupee, let us say, invested has grown to this thing. So if you want to find out the return, it will be 0.089, or in other words, if you convert into multiply by 100, you will get the return during this period is 8.9. In Excel, there is a function GM, which we'll see, which can help us in. So now you see that the geometric return is, if you calculate the arithmetic return of this thing, and you're simply adding the return
9.6.
So it is like this. So the geometric return is lower than the arithmetic return. Okay. So naturally, geometric will always be lower than the arithmetic mean because of this. And the more will be the difference, the more the dispersion. I mean, the variation, the swing in returns like this. So that is why an approximate formula is that, when you try to look at this thing, then it comes out to be like this. So 1 plus geometry is equivalent to 1 plus arithmetic mean minus standard. Standard deviation is a measure of variability of distribution, how dispersed are the return, because next we are going to discuss about the risk, then standard deviation is going to come. The more the standard deviation, the greater will be the difference between GM and AM. So I think that the basic idea why we use arithmetic return or geometric return, but as let me tell you that the most widely used method for calculation of return is arithmetic return, and geometric return is also used. As I told you that it provides a better picture of that. So the both can be used depending upon the context of investment and the holding period. Now, this was about the return aspect, how we calculate the returns, and the types of summary statistics like arithmetic mean and geometric mean are like that. But in making investment, only returns are not important. For instance, a stock is providing a return. There are two stocks, let us say X and Y. One is providing a return of 12%, another is providing a return of 18%. Now, this does not tell how risky is this investment. For example, given without risk, one may choose 18%. That this is Y is providing higher return, therefore we should make investment in Y if these two options are there. So it is the risk which is entailed by Y and X isn't. Maybe this is providing lower return, but it may not be risky. It is providing high return, which may be risky. So that is why, in order to make investment decision, return is one criteria, one factor. Risk is also another factor. So that is why we should understand how the risk of a particular stock or an asset is calculated, and how the risk when the assets are combined into portfolio, that is two or more, when they are combined together, how those risks are. So next I am going to explain to you how the risk of individual securities are calculated, and then I will also discuss the other measures like when they are combined, like covariance and other things. And I understand that most of you are aware of the standard deviation and its calculation. But even if you are not aware of, let us take a simple example to understand it. You know that this is the formula, so this may seem formidable to somebody, but it's very simple. That this formula, will take an example of that. If you look at this formula, is simply saying that the observation which range from 1 to n number of observations. So every observation is subtracted from its mean and squared. So it's d mean squared. Okay, so what we do that we sum up these deviations and divide by n minus 1, the number of observation minus 1, because to take into account, you know, the whether it is a sample or population, because so that I will, and when you take the square root of this thing, you know, then it provides a variance, and the square root of this thing will become the standard deviation. So let us take an example. Now these are the returns for various, maybe monthly, maybe yearly. The returns are it. So what is done here is that, so is added and average is taken. Okay, so 6 of 6, so it will be R bar is the mean. Now what is done is next is that these observations, these returns are, you know, 15 minus 10, 5, 12 minus 10, and in this way we arrive at this deviation 1 by 1. And please remember that since deviations we have arrived at here 5, 2, and then we square this thing. And please remember that if it is minus, and for example, if you square it, will become plus, you know. So now we have arrived at this thing, these deviations, d mean square deviations. The sum is 546. Now this 546 is divided by the number. You can divide also by 6 hard, you know, because, you know, in some cases. So we get certain, let us say, this value. Now we take, this is the variance. If we take the square root of this thing, it will become a standard deviation. The standard deviation is of the stock is sorry, is 10.45. We have taken the square root already here. You know. So in this way, the standard deviation is calculated. Why we are converting into, we can use variance also, and you will see that in portfolio risk calculation, we will use variance as well. The important thing is that one distribution which you may be aware of, normal distribution, which states that all the observation, the distribution may lie between plus minus 3 standard deviations. Now this is risk of an individual security. Now if we calculate the risk of another security and it turns out to be 15.4, naturally the Y security is riskier than this. So not only the risk, but the return aspect, not only the return, but risk aspect, maybe the 18% return which was provided by the another security may be riskier. It may have higher risk than this. So that is why the per unit of return adjusted for risk may be more important than this. So higher the SD, more the risk. Lower the SD, lower the risk in relation to others. So this is how we calculate standard deviation and the risk of an individual portfolio. Security. So all these things are explained here, and just I will hint at, because otherwise you will get glued to this thing, because next we are going to discuss about Markowitz theory. The person who has provided the theory behind how can we reduce the risk of the portfolio and all that. So there are several limitations of SD. Also, for example, that you see that plus minus deviation, if 4 is there, if you, it will become 16. So what some people have suggested that we should take into account only those negative, not why the positives are and they are both are taken as. So, but that is a debate at different level. So, but I have provided here, some idea about. And another thing is that the whether we use the standard deviation, as a measure, the that is the plus minus 3. The all the observations will be, a normal distribution, a bell-shaped curve. So we assume, so SD is based on, there is no skewness, that neither fatter tail is there or like this, or the peakedness, that is the cortices. So the third and fourth moment are not taken into account there. But since because the normal distribution is, so there is also a debate about whether SD is can be considered as as a foolproof, as a better measure for risk or not. But I think that this is not the place to discuss that. Most widely used methods like that, and and most of the models are based on normality assumption, but the world may not be of that. Just I will point out one thing which you can take note of, that it assumed that plus minus all the observations are there, but stock prices are never zero. So if that is why option prices, we take log normal, we take the natural log of the prices like that, because prices cannot be zero. And moreover, sometimes these tails, they play a very important role, like some crisis and others. So all the models of financial, risk management were based on the normal distribution. If the world does not resemble of normal distribution, then those model will go awry, like the model like value at risk and other, all these based on that. And that is why the famous Lebanese uh, investor and philosopher and all that, Nicholas Nassim Taleb, no relationship with Professor Pervez Taleb Saab. So Nicholas Nassim Taleb, he said that normal distribution is the greatest fraud of 20th century. So, but I'm steering clear of that debate just because, just to point out some of the, because everything has its own drawbacks. Now coming to another issue. Now, despite all these drawbacks, limitations, the normal distribution, sorry, the SD will provide a measure of risk for individual stocks, that if you want to calculate the risk of an individual asset or security, then standard deviation or variance, which is the square root of this, the can provide this. But when we are combining securities, like we combine two securities, then we calculate the risk of this, we calculate the risk of this, but we are combining this thing, then this will not work, because if you add just these SD of these two things, it will give a wrong picture of. The reason is simply that it may be the case we need to have a measure by which we can compute how these returns they move together, whether when the stock the return of X is moving up, Y is also moving the same way, up and up, or sorry, I think that there is some issue with that. It is getting stopped. I will share it once again. This is happening for the first time. It has never happened anyway. So what I was pointing out that the X and Y, we calculate the risk of this SD or whatever. What we are interested is that how these securities, their return move together, whether when the return of security is going up, Y return is also up, or when the return of X is falling, Y's return is also falling, or if when return is up, then Y's return is down. Now, if the return of these securities, the both are moving up, moving down, or moving, one is up, another down. So that provides an information about the chances of reducing the risk. So that is why we need to have a measure of this covariance, that is co-movement of these securities, which is known as covariance. How these two securities, they vary, how they co-vary. X and Y. If there are three securities, X and Y and Z, how X and Y, they move together. Then how X and Z move together, how Y and Z move together. So we have to have the method to like that, So various ways we arrive. So that is why in developing a formula for the portfolio risk, we need to have the calculation apart from the individual risk. We also have to look at the covariances. And covariance provides us the information about how much risk reduction is possible if we combine securities together, portfolio 2, 10, like that, whatever number. What are the chances? If there are securities which are moving in a similar direction, similar fashion, similar way, then the chance of risk reduction is lower. And therefore, that will not be beneficial for diversification for risk reduction. How we calculate covariance? There is a formula. The formula is very simple. You recall that in standard deviation, same formula is there. Only there are two securities, let us say I and J. So here R bar was, and we had squared there. So same way we also take the deviation, the first security, up to number of period, T. And here, this is another security G. So again, what we do that we we subtract the return of security I from the mean return of that security. Similarly, we multiply by again the return of security J minus the return of security, mean return of the security J. So it is like instead of squaring it, and then we add it. You see that this, and then divide by the number T is here, R is the number of observation are there. We arrive at the covariances. Okay. And this will provide us the idea whether this covariation is positive, negative. It will give a number, maybe 110, 120, or minus something like that, whatever. So, but this may not be very meaningful. Okay, that will give us an idea. So that is why what we do that we scale it on a scale. We scale it from plus, which ranges from +1 to -1. So if a stock which is which is, for example, has got perfect correlation moment, then it will not provide any chance of risk reduction. Whereas a stock which has got negative perfect correlation, then it can help us in reducing the risk to zero. And that is why we scale it on to arrive at both the figure. You see that this is the covariance of a security, which I just explained to you how we calculate it. So this we scale it by their respective standard deviation, like SD of I and SD of G, product of this, divide by this thing. Then we get correlation. It is like a scale, we scale. Either way, if you cross multiply this, you will get the same thing. If you are given correlation and the standard deviation of Indian securities, you will write it. So it is, we use it because if now you get a number of 540 minus 110, so it will not be, you can understand that this has got high correlation, high covariance, but it will not. But if I tell you that it is 0.2, it means that 20% variation is positive variation. They move 20% in positive. If I tell you that it is 0.8, so it means that very highly correlated, 80%. So there is not much. The more you move to 0.9 or something like that, they are moving in perfect tandem and lockstep. So to lower the correlation, greater the chance of the risk reduction. So this I have already explained to you. This is calculation I will show to you. In the RU, I will advise you that in next class when we meet, then you should work out yourself, because this is not something which is very difficult. Now this correlation concept which I am explaining to you can be understood by this. For example, there are two securities. So if the positive correlation is there, then it will be upward sloping. Perfect, all the points are X and Y are lie on the same. And zero correlation, there is no, hardly we find securities which have no correlation. Negative means that, this is negative, but this is the perfect negative correlation, -1. This is +1. Maybe minus 0.2, something like that, but maybe lower than this. So there are positive correlation, negative correlation, but not the perfect. So perfect means that plus triangle between -1. So this is the graphical representation of this, because this is the building block, these concept, like a return concept which I have discussed, and the concept of risk which I have discussed, that acts as the building block for our understanding of the portfolio risk and portfolio return calculation. Portfolio return calculation is straightforward. There is no difference. Only thing is that the how much money we are investing in a particular stock, we multiply by the return and like that. So if you have any question, you can ask before I just will introduce you to what I am going to discuss in next class.
Good afternoon, sir.
Yes, please identify yourself and okay, if possible. Okay.
My name is Aditya Sharma, and my doubt is that in India the inflation is relatively higher as compared to USA. So the foreign players, like the investors in USA, are investing more in India right now. But since the inflation is higher, the returns are correspondingly higher too. So they are earning more. But as you told us, the exchange rate, it acts as a counteracting force, which reduces the returns, right? So, sir, why does it like that? The exchange rates are in the counteracting manner, and how are they controlled, or they act naturally?
You see that exchange rate is not controlled. That the flow of, you are right to some extent, that flow of foreign investment, affect exchange rate also. Okay. So what happens that if a lot of dollar flows, okay, in the market, so what will happen that the rupee will get appreciated, isn't it? Because more dollar will come and like that. So the RBI actually, RBI also intervenes in the market, by buying and selling. If RBI think the rupee has appreciated and it should, so you may recall in the first year I had discussed about foreign exchange market intervention, buying and selling of foreign currency to affect the exchange rate. Now coming to the second point. The second point which you say that the inflation in US is naturally, US is very low, and in some countries it's negative in a Japanese economy, and like that. That is why the rate of interest is also return is very low there, and they 4-5% if they get it is a huge return for them. But so they in emerging market like India, they are providing better revenues for investment. So these FIs, when they make investment here in India, so you know that the rupee may depreciate, but the gain on account of the return, which are, for example, normally for 14-15% return is very common. If the annual depreciation of rupee is more than this, they may affect it. But because they are the foreign institutions, so they have better fund managers and like that. So their return may be much higher than that even. So they also undertake another thing. For example, if they are investing for 1 year or something like that, so they cover it with the hedging tools. Okay, hedging tools are there. Like that if they think that after this period they approximately they will have 1 million. Okay, in so they when they convert it, they buy also the derivatives to cover it. This is called covered. So that they can lock in if there is a the depreciation is nullifies the gain. So by and large, depreciation has been lower, than the return which. So that is why even if you do not use it by hedging it, in foreign exchange market, yet they can get higher return than what they will get in US. And that is the reason why there is a huge inflow of the portfolio investment in our country, where they are getting only 2-3% and like that. So because they will send back remit money to their country. So, and the purchasing power will not be governed by India purchasing power, where the money will go back finally. Have you got the point?
Yes, sir. Very much. Thank you very much, sir.
So, hello, sir. My name is Nidal Ahmed. I have a similar question in this so it means that while investing across border, the investment period should be relatively smaller.
Cross-border investment, who will take individual investors, that it is not possible for individual investors to, they can buy it, they can use it, but, they can participate, retail investor especially, they can participate in global mutual fund or something like that, which makes investment across. So this is one way indirectly they can. But FIs, naturally, they have got huge money. So they are not small players, okay? So they are, and therefore they, for example, in India and elsewhere, because of huge foreign exchange flow of the rupee has appreciated, where exporters need a depreciating rupee to compensate for the rise in price. Because if inflation in India is more than 8, let us say 10%, in US it is 2%, according to purchasing power, the rupee should depreciate by. And you see that it is if there is a too much dollar flow, then rupee they will demand for rupee more, because when they send dollar, it will be converted back. So it may be nullified, the counter what we So that is why sometime it happened that the government or the RBI, naturally RBI is the wants to do otherwise, and because of huge RBI has to intervene in the foreign exchange market by pumping dollars from its reserve to arrest this. Although we have got healthy, huge foreign exchange reserves, yet these are the issues when the free flow of capital takes place across the border. They can affect exchange rate. They can make, and sometimes they can. Yesterday I was discussing about hedge funds. Hedge funds have got huge amount when the minimum investment is $1 million US. So they are sitting on huge corpus of funds. When Southeast Asian crisis in 1990s, because of currency crisis happened, so they ruined the Southeast Asian. They marked their currency rates and everything. That is why Mahathir Mohamad imposed a capital restriction that you can't send money from the Malaysia. So that was there was hue and cry, but that arrested the decline of the foreign currency. So that is why the free flow of capital has also got its side effects, and that affects it in this way. So I hope that you may have got some answer. If you have opted international finance, have you opted? Nidal Ahmed.
Yes, sir. Sir, I'm in IBF.
I have no issues with that, but I have explained to you in very brief, because in IF we go in that detail, but wait for 5th unit also. There we will discuss about the global portfolio diversification, because global portfolio provides better, risk return possibilities as well. So,
Sir, I have another question related to correlation here. Sir, if the coefficient is +1, then it means the stock prices of X and Y are, if one is going up, so the other one is going down
no, not
proportionately.
down. You
Right?
just see here the diagram itself, that you see that if you plot this point here like that, if they are X and Y, if positive value only will be that if both are going up, isn't it? But here it means that 10% this, 10% this, like this. So then it will be 100% in log step fashion. But 10% and 8%, they are moving in positive, correlation will be positive, but will not be 100%. I mean, one, it will not be one.
Right. Okay, sir. Okay. I got it now.
Because if they are moving and up, it means that if the stock market is up, you will gain it. If the stock market is down, both will down the same way. So you need some securities where if the return is going up, the other is compensated by here. For example, if you are gaining here, they may be, but if it is going down, then it may, be compensated by that. That is why we need which are not perfectly correlated. In real life, it is very difficult to get securities which are perfectly negatively correlated, but we look at the lower correlation. The lower the correlation, given other things, there are greater chance of risk reduction. Otherwise, they will move in the same fashion. You see that here plotted. So that is the bedrock of portfolio risk, theory of Markowitz, which we will study in the next class. Okay. So I stop. If you do not have any further question, I will stop, and then we will start from the next unit. This was just sort of a background and preparation for the discussion there. Otherwise, I could have asked you to study correlation, coefficient, and standard deviation. We'll also use this Excel once we have gone through these to calculate these. Okay.
Okay, thank you, sir.